In this video, I'm going to cover 9 money myths that people have in their head that hold them back from getting financially ahead. Some of these concepts might not be as obvious, so make sure you watch until the end of this video to get all the tips I'm going to share with you. And if you like content on personal finance and different types of financial concepts, make sure you like, comment, and subscribe to this channel because I post content like this every single week on how to improve your finances and different types of strategies to get financially ahead. These myths aren't covered in any particular order, but for the first thing that I'm going to share with you is debt. All debt is bad. So people have this misconception that if you use debt, it's a bad thing, but that's not necessarily true. Bad debt would be considered buying luxurious items like things like clothes, jewelry, cars, things that can never appreciate in value, that tend to depreciate over time. That's what bad debt is, when you use debt to buy consumer items that don't go up. Good debt would be when you use debt to buy things that can appreciate in value. So an example of good debt would be, say, investing in a real estate property. So when you invest in a real estate property, you have a chance for it to appreciate in value considering that you got a good property because you're borrowing money from the bank to get a return from your investment from your real estate. And hopefully if you made a good investment, you can make more from the cash flow of your real estate property than it costs you for the debt that they're charging you at the bank. And another form of good debt would be a high cash value life insurance policy where if it's properly structured, you could borrow from the insurance company at a cheaper rate, say 4%, and you could earn, say, an average rate of 7% from your insurance policy. So every time you're borrowing from your insurance contract, your cash value life insurance contract, you make money when you're borrowing from it. So these are forms of good debt because these are assets that can potentially appreciate in value. So whenever you want to think about good debt versus bad debt, the key thing to know is, can this asset appreciate in value? If it can't, the chances are it's probably bad debt. The second money myth that people have in their head is, don't talk about your money problems with other people, or that problem isn't important. The thing is, when it comes to anything in your life, the best way to make a problem worse is to ignore it and act like it doesn't exist. Money plays an important factor in everyone's life. And the fact that we ignore it, the fact that many people ignore it, is the reason why a lot of people probably are living paycheck to paycheck. A majority of people are living paycheck to paycheck. There's nothing wrong with being around groups of people that are comfortable talking about money. If accomplishing financial goals is important to you in your life, it's probably really important for you to be around groups of people that are comfortable and are happy to share different types of financial goals and financial tips to get financially ahead. Whether it's about how to invest or how to save in a way where you could shorten the time span to get to your goals. And normalize being comfortable around those group of people and sharing different goals and different strategies and how to save and invest money to reach your financial goals in a reasonable time. The number 3 money myth is that the bank is the safest place to put your money. I'm sure everybody has realized by now that all these things in terms of gas, food are going up in price drastically, and inflation this year is 8%. And if you think about it, how safe is a place to put your money if every year it's getting 8% less? Hopefully inflation doesn't keep on pace. And if you even think about it, the banks don't even save the money in the bank. So why should you save your money at the bank? The banks save their money in cash value life insurance policies where they could get 3 to 4% on their money while they're paying us, the people that are saving money in the bank, 0.06% on our money. So what do the banks believe in? The banks believe in lending money out at interest rates of, say, 4% in the form of like loans and mortgages for people's homes, and in the form of credit card debt when sometimes it gets 15 to 20%. And they also believe in buying assets like cash value life insurance and real estate so they could constantly grow their money. So you should operate in a similar way like the bank. Make sure that you always have your money in a position where it's growing and your money isn't just sitting there doing nothing. You won't be able to reach your financial goals just by saving money at the bank, so you have to find better alternatives to grow your money. Number 4 is that you need a lot of money to start investing or growing your money. Really, when it comes to this, all you really need is a consistent source of income and some sort of plan that you could stick with for long periods of time and continuously do that. Because the thing is, in order for you to invest $10,000 or save $10,000, you first have to be able to save $1,000. In order to save $1,000, you have to be able to save $100. So it all starts with financial discipline. If you don't have financial discipline, there's no financial plan that will work for you. And even if you make a lot of money, if you don't have financial discipline, you'll end up spending it all. So you have to build those good habits of saving and investing money first when you have a little bit of money, because if you can't do it when you have a little bit of money, you're not gonna be able to do it when you have a lot of money. Number 5, kind of to add on to what I was saying before, is that a high income is what makes you wealthy. Sure, a high income can help the process and speed up the process of being wealthy, but at the same time, if you don't have those financial habits, like I was saying before, if you don't have the financial discipline, and you, as soon as you make more money, you spend more money, having a higher income won't really add more freedom to your life. Because all really wealth is a ratio between how much you make and how much you spend. And if you want to think about someone who's very wealthy might spend, say, 10% of their income. So every year that they earn money, basically that covers 10 years of expenses. So they don't necessarily even have to work for 10 years just because that 1 year they earned. And they're able to continuously do that. And if you get to the point where your investments are paying for that expense, then you're extremely wealthy. Number 6, you need to retire at age 65. So the thing is, when it comes to retirement, financial freedom, or financial independence, or whatever you want to call it, there's no age for retirement or any of those type of financial goals that you want. It's really just about the money that you have. Do you have enough money and income coming in to take care of your expenses every single year for the rest of the time you live? So really, at the end of the day, you just need money to retire. You don't necessarily need to hit an age to retire. And the thing is, you don't necessarily have to use retirement accounts where they lock you until 59 and a half. Like you think about traditional 401ks and traditional IRAs. A lot of these plans, they constrain your money and you can't use your money, or you get penalized when you use your money too early. So if you want to find more efficient ways to save and grow your money and invest your money, there's other alternatives you could do, and focusing on making a high income and investing in asset classes that don't lock up your money. And I'll actually link a video at the end and different types of strategies you could use to speed up that process, where you could take your 40-year goal to a 20-year goal. But just by learning about better strategies and different ways to earn more money and be financially disciplined to invest that money, will end up going a long way, and you might not even have to retire at age 65. You really, at the end of the day, you just need money to retire. You don't necessarily need an age to retire. Number 7, life insurance is too expensive, or life insurance is for rich people. The thing is, if you actually think about it, for someone that isn't making a lot of money, people say they can't afford it, but technically they can't afford not to have it, because if something happens to them, the people that are taking care of them, the people that are liable for anything that might happen, because they don't have that source of income, or maybe they have to take care of final expenses or whatever it is, they might not be able to sustain or afford to keep the lifestyle that they have, because they're in more of a financial burden because you're not there. And the thing is, people don't realize how cheap life insurance can actually be. For a 30-year-old male that's getting a $250,000 policy, say it's a term policy, you could get it for $30 a month, even less sometimes when it comes to term insurance. And if you want to even think about the other side of the spectrum, where you talk about wealthy people, technically speaking, wealthy people don't need life insurance. But why do a lot of wealthy people use life insurance? Because the tax benefits and the accumulation benefits. And it's a safe place for them to save their money and get a decent rate of return, a much better rate of return than the bank. So they can prepare for different problems, opportunities that might happen in their life, their business, or whatever. And they have a place where they could earn a decent rate of return rather than a 0.06% rate of return that they do at the bank. So regardless of what side of the spectrum you are, whether you have a lot of money or a little bit of money, having a life insurance policy will always be beneficial to you, because it does so many different things in terms of protection for your family. And also, if you're using it as a cash accumulation vehicle where you're saving money into it, it protects you against so many different risks that a lot of different investments can't do. Because at the end of the day, investments aren't guaranteed. And you should have investments, but you should also save your money in a place that gives you a decent rate of return. You work hard, you deserve to buy nice things. If your priority is financial independence or financial freedom, the first thing you should do is pay yourself first. Those things like vacation, luxury, and all those other things that you might want in your life might not be what you immediately need if you're trying to accomplish a goal like that. And practicing things like delayed gratification and just waiting to enjoy yourself in terms of buying nicer things or buying luxury is going to be really important to accomplishing a goal like financial independence. Because without delayed gratification, you're not going to be able to reach those goals that you want in any type of reasonable time, especially if you're trying to do something like have financial independence or retire before age 65. In order to get above average results, you have to do above average effort and above average planning in order to reach those goals. And it might take things like pushing back things like vacation spending and whatever it is, or working more or learning a new skill to get that goal faster. The last money myth that I'm going to share with you is that people say that buying a house is always smarter than renting. The thing is, sometimes people end up putting all the money into a house and they end up being cash poor, meaning that all the money that they have is in the equity of the house. So if something happens, like something in the house breaks down, the car breaks down, or some sort of emergency, they don't really have access to cash and they're forced to use things like high interest debt to take care of emergencies. And prioritizing having 3 to 6 months of savings is going to be really important for you to get financially ahead, because it's going to give you something to fall back on when and in case things happen. And if you can't get to 3 to 6 months right away, it's fine. Try to at least get to $2,000 in savings where you have access to it somewhere liquid, where it's not at risk anywhere in terms of the stock market or cryptocurrency or anything. You just want to make sure it's liquid and you can access it to take care of those emergencies right away. Being cash poor is the worst type of poor because you're always going to be dodging mines and you don't want to be in that position. So you want to make sure that you have that safety cushion in case something happens. Those are 9 myths that people commonly have about money. I'm sure there's a lot more. And if you think that I missed some, please comment below and tell me what are some of the money myths that people have told you, or some of the things that you've heard. Love to hear that. And if you like content on personal finance and different types of financial concepts, make sure you like, comment, and subscribe to the channel Financial Ownership, because I make videos like this every week. As always, thank you and see you next time.